95%. That is the number that haunts every trading floor, every brokerage account, every online forum where people gather to talk about making money in the markets. 95% of futures traders lose everything within their first year. Stock traders don't fare much better. Most of them fail to outperform a simple buy and hold investment, a strategy that requires nothing more than purchasing an index fund and going to sleep for a decade. Now think about who these people are. They are not fools, they are not lazy. They are doctors, lawyers, engineers, scientists, CEOs, wealthy retirees, and entrepreneurs. Some of the brightest, most accomplished people in society. People who have mastered complex disciplines, built companies, saved lives, designed bridges, and argued cases before judges. And yet, when they sit in front of a trading screen, they are systematically destroyed. Why? That is the question that consumed a man named Mark Douglas for over 17 years of his life. And the answer he arrived at is so simple, so devastatingly, elegantly simple, that most traders refuse to believe it when they first hear it. The answer is not about the markets. It's not about charts or indicators or finding a better entry signal. The answer is about how you think. The best traders in the world, the ones who pull money from the market with the consistency of a paycheck, are not smarter than everyone else. They don't have access to better information. They don't use some secret indicator that nobody else knows about what they have. And what separates them from the other 95% is a different way of thinking. A specific set of beliefs and attitudes that allows them to remain disciplined, focused, and above all, confident, even when the market is doing everything in its power to shake them loose. They have what Douglas calls the trader's mindset. And in the pages ahead, we are going to build that mindset, piece by piece, belief by belief, truth by truth, until trading becomes as easy and simple as it always looked when you were just watching from the outside. This is Trading in the Zone. Before we dive into the chapters themselves, there is something I want you to do. Something that Mark Douglas asks every reader and every trader who attends his workshops to do before they begin. He calls it the Attitude Survey. It is a set of 30 questions designed to reveal where you are psychologically as a trader right now. In this moment, before you have absorbed any of the ideas in this book. I am not going to read you all 30 questions, but I want to highlight a few that are particularly revealing, because they illuminate the assumptions that most traders carry into the market without even realizing it. Question 1. To make money as a trader, you have to know what the market is going to do next. Agree or disagree? Most traders say agree, and that single word, agree, is the root of most of their problems. Because if you believe you must know what the market is going to do next, then every time you don't know, which is every single moment, you feel inadequate. You feel anxious. You feel compelled to figure it out. And that compulsion leads you to analysis paralysis, to hesitation, to overcomplication, and ultimately to trading errors. The truth that the best traders have internalized is that you do not need to know what the market is going to do next. You only need to know what you will do next, regardless of what the market does. Question 5. When I get into a trade, I always determine the dollar amount of risk. If your answer is anything other than an unconditional yes, you are trading without one of the most fundamental principles of consistent profitability. Defining your risk before entry is not optional. It is not a nice to have. It is as essential to trading as a seatbelt is to driving. You can drive without one. But eventually, the consequences will be severe. Question 22. No No matter how much money I make in a trade, I am rarely satisfied and feel that I could have made more. If you agree with this statement, and most traders do, it reveals something important about your relationship with success. It means that winning isn't enough, that no amount of profit can satisfy you, because there is always more that could have been captured. This dissatisfaction doesn't come from the market. It comes from a belief that you should always extract the absolute maximum from every opportunity. But here is the problem. Trying to capture every last penny from every trade is the fastest way to give back your profits. The pursuit of perfection in an inherently imperfect activity is a form of self-sabotage. The best traders take what the market offers. They do not demand more, and their satisfaction comes from executing well, not from maximizing every trade. Question 25. If you were granted a wish to be able to instantaneously acquire one trading skill, what skill would you choose? Most traders say they want the ability to predict the market accurately. They want a crystal ball. They want certainty. But the best answer, the answer that reveals a mature trading mindset, is this: the ability to completely accept the risk of each trade. Because that single skill, true acceptance of risk, eliminates fear, eliminates hesitation, eliminates recklessness, and creates the conditions for every other skill to function at its best.
Let me take you back to a time that most people in today's markets have completely forgotten. A time when the very idea of reading a price chart was considered, and I am not exaggerating, a form of mystical hocus pocus. In 1978, when Mark Douglas first started trading, fundamental analysis was the only respectable way to make a trading decision. If you wanted to be taken seriously on Wall Street, at any of the major funds, or at any financial institution, you talked about earnings, interest rates, supply and demand models, balance sheets and mathematical projections, technical analysis. The art of reading patterns in price movement was practiced by a tiny handful of traders who were politely, and sometimes not so politely, considered crazy. Now, stop and think about how dramatic that shift has been today. Almost every experienced trader in the world uses some form of technical analysis. The purely fundamental analyst has become a relic, found only in small, isolated pockets of the academic world. What caused this revolution in thinking? The answer is blunt, and it is honest. Money. The problem with fundamental analysis was never that it was illogical. It was perfectly logical. Take every variable that could affect the price of a stock, a commodity, or a financial instrument. Interest rates, weather patterns, balance sheets, inventory levels. Feed them into a mathematical model and project where the price should be in the future, rational, reasonable, and consistently wrong in ways that cost traders fortunes. Here is why people make prices move, not models, and people do not always act rationally. A fundamental model can produce a perfectly logical projection about where a price should be 6 months from now. But between now and then, the actual humans who are buying and selling, especially the floor traders who can move prices dramatically in one direction, may not know about the model, may not believe in it, and most importantly, may be making decisions based on emotions that exist completely outside the parameters of any mathematical formula. The fact that a model makes a logical and reasonable projection based on all the relevant variables is not of much value if the traders who are responsible for most of the trading volume are not aware of the model or don't believe in it. And so the trading world began its slow migration toward something different, toward watching what the market actually does, instead of what models say it should do. The technical analysts had figured something out that took the mainstream establishment decades to accept. And it was this: a finite number of traders participate in the markets on any given day, week, or month. Many of these traders do the same kinds of things over and over again. In their attempt to make money, individuals develop behavior patterns. Now, take a group of individuals interacting with one another on a consistent basis. What happens? They form collective behavior patterns. And these collective behavior patterns are observable. They are quantifiable. This is the crucial part. They repeat themselves with statistical reliability. Technical analysis, at its core, is a method that organizes this collective behavior into identifiable patterns that can give a clear indication of when there is a greater probability of one thing happening over another. It allows you to get into the mind of the market, to anticipate what is likely to happen next, based on the kind of patterns the market generated at some previous moment. Where fundamental analysis creates what Douglas calls a reality gap. The gap between what should be happening and what actually is happening. Technical analysis closes that gap. It turns the market into an endless stream of opportunities. The same patterns appear in every time frame, moment to moment, day to day, week to week, year to year. The possibilities become virtually unlimited.
And here is where things get interesting. Because if technical analysis works so well, if it truly turns the market into an endless stream of opportunities to make money, then why do most traders still fail? This question, this maddening, frustrating, seemingly impossible question, is what led the trading community to make yet another shift. Not from fundamental analysis to technical analysis, but from technical analysis of the market to mental analysis of themselves. Think about your own experience for a moment. How many times have you looked at a price chart and said to yourself, "It looks like the market is going up," and then watched it go up without you in it? You were right about the direction. You saw the pattern. You understood the opportunity, but you didn't act. You sat there, paralyzed, watching money flow in the direction you predicted, anguishing over all the money you could have made. Or perhaps worse, you put on the trade, but you couldn't stay in it. The market moved against you by a few ticks, and you panicked and got out. Then you watched it reverse and go exactly where you expected. There's a big difference between predicting that something will happen in the market and the reality of actually getting into and out of trades. Douglas calls this difference the psychological gap, and it is this gap, not a gap in market knowledge, not a gap in analytical skill, that makes trading one of the most difficult endeavors you could ever choose to undertake. Now, here is the question that really matters. Can this gap be closed? Can trading actually become as easy and simple as it felt when you were just watching from the sidelines? The answer is yes, unequivocally. Absolutely yes. There are people who have done it. They have mastered the art of trading and closed the gap between what they see in the market and what they actually do about it. They trade with ease, with simplicity, with a kind of stress-free flow that most people cannot even imagine. But these people are rare, compared to the number of traders who experience varying degrees of frustration, all the way to extreme exasperation. The consistent winners are a tiny fraction, and the differences between these two groups are not what you think. The consistent winners are not smarter. They don't work harder. They're not better analysts. They don't have access to superior trading systems. They don't possess some inherent personality trait that makes them more suited to handle pressure. If you took a survey of the biggest consistent losers in the trading industry, you would find that this group is composed primarily of some of society's most brilliant and accomplished people. And here is perhaps the most shocking fact of all. Many of the industry's best market analysts, the people who can read a chart with more precision and insight than almost anyone alive, are the worst traders imaginable. Intelligence and good analysis contribute to success. Nobody's denying that. But they are not the defining factors. They are not what separates the winners from the losers. What separates them is this: the best traders think differently from the rest. That sentence sounds simple, maybe even too simple, but consider its implications. We all think differently from each other. The way we think is what makes us unique, probably even more unique than our physical features. And when it comes to trading, the specific way that consistent winners think about risk, about loss, about opportunity, about the market itself, it is fundamentally different from how everyone else thinks about these things. The defining characteristic that separates the consistent winners from everyone else is this: the winners have attained a mindset, a unique set of attitudes that allows them to remain disciplined, focused, and above all, confident, in spite of the adverse conditions. Everyone who trades ends up learning something about the markets. Very few people who trade ever learn the attitudes that are absolutely essential to becoming a consistent winner. Just as people can learn the proper technique for swinging a golf club or a tennis racket, their consistency, or lack of it, will come from their attitude. The ones who make it past what Douglas calls the threshold of consistency usually experience a great deal of pain, both emotional and financial, before they acquire the kind of attitude that allows them to function effectively.
And here is the paradox at the heart of everything. Trading is inherently risky. No trade has a guaranteed outcome. The possibility of being wrong and losing money exists on every single trade. So when you put on a trade, you are taking a risk that seems obvious. And most traders will readily agree with it. In fact, many traders take pride in thinking of themselves as risk takers. But here is the uncomfortable truth. Most traders have absolutely no concept of what it means to be a risk taker in the way a successful trader thinks about risk. The best traders not only take the risk, they have learned to accept and embrace the risk. There is a huge psychological gap between assuming you are a risk taker, because you put on trades, and fully accepting the risks inherent in each trade. When you fully accept the risks, it will have profound implications on your bottom line. The best traders can put on a trade without the slightest bit of hesitation or conflict, and just as freely, without hesitation or conflict, they can admit that the trade isn't working and get out, even with a loss, and doing so doesn't create the slightest bit of emotional discomfort. The risks inherent in trading do not cause the best traders to lose their discipline, their focus, or their sense of confidence. If you cannot trade without the slightest bit of emotional discomfort, specifically fear, then you have not learned to accept the risks inherent in trading. And to whatever degree you haven't accepted the risk is the same degree to which you will avoid the risk. And trying to avoid something that is unavoidable, trying to avoid risk in an activity that is defined by risk, will have disastrous effects on your ability to trade. Think about what we are generally most afraid of, besides dying, or public speaking certainly. Losing money ranks near the top. And being wrong, admitting we are wrong and losing money in the process can be extremely painful. And yet, as traders, we are confronted with these two possibilities virtually every moment. We are in a trade. Trading presents us with a fundamental paradox. How do we remain disciplined, focused, in the face of constant uncertainty? The answer, according to Douglas, is that you must learn how to redefine your trading activities in a way that allows you to completely accept the risk. Not intellectually, not as a nice idea that sounds good in theory, but at the deepest level of your being. Learning to accept the risk is the most important trading skill you can learn. And yet, it is the one skill that developing traders almost never focus on. When you learn this skill, the market will not be able to generate information that you define or interpret as painful. The information will simply be information, revealing what the possibilities are. You will see it objectively, without distortion, without fear coloring your perception. But until you learn the skill, fear will be your constant companion, and fear is responsible for 95% of the errors you will ever make as a trader. Think about those errors. You've probably made most of them yourself, getting into trades too soon, before the market has actually generated a signal, getting in too late, long after the signal appeared, convincing yourself not to take a loss and watching it grow larger, getting out of winning trades too early, being in a winning trade and failing to take any profits, watching the trade turn into a loser, moving your stop loss closer to your entry point, getting stopped out, and then watching the market go exactly where you expected. These are not market-generated errors. The market didn't do any of this to you. The market is neutral. It moves. It generates information. It provides each of us with the opportunity to do something. But that is all. The market has no power over the unique way in which each of us perceives and interprets this information. It has no control over the decisions and actions we take as a result. These errors are the result of what Douglas calls faulty trading attitudes and perspectives. Attitudes that foster fear instead of trust and confidence. The best traders are not afraid. They have developed attitudes that give them the greatest degree of mental flexibility to flow in and out of trades, based on what the market is telling them. At the same time, they have developed attitudes that prevent them from getting reckless.
Let me describe the blame cycle in more detail, because it is one of the most insidious patterns in trading, and the most common. Stage 1. You have a trading system. It generates signals. You follow it and win. Stage 2. You develop confidence. You start to believe you understand the market. Stage 3. You take a trade outside your system because you see something, a pattern, a feeling, a hunch. It wins. Stage 4. You take another trade outside your system. This one loses, but it was a small loss, so you dismiss it. Stage 5. You take a larger trade outside your system. It loses big. Stage 6. You blame the market. Not yourself, not your decision to deviate from your system, not your hubris, the market. And this is where the real damage begins. Because once you blame the market, you have externalized the problem. And if the problem is external, if the market is the cause of your failure, then the solution must also be external. More analysis, more indicators, more data, more learning about the market. And so the cycle continues. You learn more. You feel smarter. You develop confidence again. You start deviating again. You lose again. You blame the market again. Each cycle reinforces the same pattern. Each revolution tightens the spiral. And with each revolution, the trader moves farther and farther from the truth, which is that the problem was never the market. The problem was always the decision to deviate from a proven process. Breaking this cycle requires a radical act of honesty. It requires you to look at your trading journal. You do keep a trading journal, don't you? And separate every trade into two categories: trades that followed your system and trades that didn't. When you make this separation, when you isolate the trades that deviated from your rules, you will almost certainly discover that the source of your losses is not your system. It is your behavior. Your system, when followed consistently, probably produces a reasonable return. It is the deviations, the rogue trades, the impulse trades, the I know better trades that are destroying your results. This is a profoundly liberating discovery because it means you don't need a new system. You don't need better indicators. You don't need more education about markets. What you need is the ability to follow your own rules, and that ability is psychological, not analytical. Taking responsibility means accepting this truth, not grudgingly, not partially, completely. It means saying to yourself, my results are a direct reflection of my behavior, and my behavior is a direct reflection of my beliefs. If I change my beliefs, I change my behavior. If I change my behavior, I change my results. That is the simple, elegant, powerful logic of taking responsibility. And it is the cornerstone of everything that follows. Everyone else is afraid to some degree. And when they're not afraid, they have the tendency to become reckless, to overtrade, to take positions that are too large, to violate their own rules, which then creates experiences that make them afraid again. 95% of the trading errors you are likely to make will stem from your attitudes about 4 things: being wrong, losing money, missing out, and leaving money on the table. Douglas calls these the 4 primary trading fears. When you are fearful, no other possibilities exist. You can't perceive other possibilities or act on them properly, even if you did manage to perceive them, because fear is immobilizing physically. It causes us to freeze or run mentally. It causes us to narrow our focus of attention to the object of our fear. And so the trader who is afraid of being wrong will, through that very fear, cause himself to do things that make him wrong. The trader who is afraid of losing money will, through that very fear, cause himself to lose money. Fear doesn't protect you in the markets. It creates the very outcomes you are trying to avoid.
Now you might be thinking, if the solution isn't in learning more about the markets, then what is the solution? Douglas presents 2 choices. The first, you can try to eliminate risk by learning about as many market variables as possible. He calls this the black hole of analysis, because it is a path of ultimate frustration. No matter how much you learn, the market can always do something you didn't anticipate. It can do anything at any moment. Every person who trades is a market variable, and any single trader can cause virtually anything to happen. No matter how much you learn, you will never learn enough to anticipate every possible way the market can make you wrong or cause you to lose money. And if you are afraid of being wrong or losing money, you will never learn enough to compensate for the negative effects these fears have on your ability to be objective and act without hesitation. The second choice, the one that actually works, is to learn how to redefine your trading activities in such a way that you truly accept the risk and are no longer afraid. When you have achieved that state of mind, when you truly accept the risk, you will not have the potential to define and interpret market information in painful ways. And when you eliminate that potential, you also eliminate the tendency to rationalize, to hesitate, to jump the gun, to hope that the market will give you money, or to hope that the market will save you from your inability to cut your losses. The irony is beautiful. When you have the appropriate attitude, when you have acquired a trader's mindset and can remain confident in the face of constant uncertainty, trading will be as easy and simple as you probably thought it was when you first started out. Let me illustrate the psychological gap with something more concrete. Consider two traders looking at the same chart at the same time. Trader A has a profitable position. The market has been moving in his direction all morning. He's feeling great confident. When he looks at the chart, he sees continuation patterns. He sees reasons to stay in. He sees opportunity. The price action looks beautiful to him. Each candle confirms his analysis. Each pullback looks like a buying opportunity. Trader B is on the other side of the trade. He is short, he is losing, he is afraid. When he looks at the exact same chart, he sees something completely different. He sees overextension. He sees reasons why the market should reverse. He finds support levels that Trader A doesn't even notice. Every green candle feels like a personal insult. Every pullback fills him with false hope. Same chart, same information, same market. Two completely different perceptions, two completely different realities. Which trader is seeing the market accurately? Neither both are seeing their internal states reflected back at them from the screen. Trader A feels good, so the chart looks good. Trader B feels bad, so the chart looks bad. Neither is perceiving the market from the market's perspective. Both are perceiving the market from their own perspective. A perspective shaped by their current emotional state, which is shaped by their current position, which is shaped by their beliefs about what they expect the market to do. This is the gap. The gap between what the market is doing and what you perceive the market is doing. And you cannot close this gap by learning more about the market. You can only close it by changing the mental framework through which you perceive it. A truly objective trader. A trader operating from the 5 fundamental truths would look at that same chart and see information. Not good information, not bad information, just information. He would see what is happening without coloring it with his hopes, fears, or expectations. He would assess the probabilities, check his edge, manage his risk, and act or not act based on what the market is telling him, rather than what his emotional state is telling him. That is objectivity. And objectivity in the face of financial risk is one of the hardest psychological states to achieve. But it is possible. And the path to achieving it runs straight through the material in this book. The successful trader that you want to become is a future projection of yourself. Something you have to grow into. Growth implies expansion, learning, a new way of expressing yourself. Many of the new ways you will learn to express yourself will be in direct conflict with ideas and beliefs you presently hold about trading. These internal arguments are natural, but they can be resolved. And that is what we are here to do.
In January of 1994, Mark Douglas was sitting at a luncheon during a trading conference in Chicago. Futures magazine. Beside him was an editor for one of the major publishers of trading books. They were having a lively conversation about a puzzle that never seems to get old. Why so few people become successful at trading? Even people who are extraordinarily successful in every other aspect of their lives. At one point, the editor asked a question that seemed innocent enough. Maybe, he suggested, people get into trading for the wrong reasons. Douglas paused. He had to think about it. And then he said something that reframed the entire conversation. The true underlying attraction to trading is far more fundamental, and universal trading is an activity that offers the individual unlimited freedom of creative expression.
a freedom of expression that has been denied most of us for most of our lives. Think about that for a moment in the trading environment. We make almost all of the rules. There are very few restrictions on how we can choose to express ourselves. Once you have the ability to place a trade, the possibilities for how you go about doing it are virtually limitless. Someone once calculated that if you combine bond futures, bond options, and the cash bond markets, there would be over 8 billion possible spread combinations. 8 billion. Now add timing considerations based on how you read market conditions, and the ways to trade become essentially infinite. The editor paused and asked the obvious follow-up. But why would having access to such an unrestricted environment result in fairly consistent failure? And here is where Douglas delivered the insight that most traders never see coming. Unlimited possibilities, coupled with the unlimited freedom to take advantage of these possibilities, present the individual with unique and specialized psychological challenges that very few people are properly equipped to deal with or have any awareness of. This is the central tension of trading. The freedom is real. The freedom is intoxicating. All of us seem to naturally want it, strive for it, even crave it. But that does not mean we have the psychological resources to operate effectively in an environment that has few boundaries, and where the potential to do enormous damage to ourselves exists around every corner. To understand why this freedom is so dangerous, you need to understand something about how we were all raised. Every human being is born into a social structure, a family, a city, a country, and a social structure, by definition, means rules, boundaries, restrictions. A code of behavior that limits the ways in which individuals can express themselves. Most of these rules were established before we arrived. By the time we came into the world, the structure governing our individual expression was already deeply entrenched. And here is what matters. Much of this structure was instilled in us, not chosen by us. As children, we naturally wanted to explore, to touch, to experience, to learn. We were driven by curiosity, an inner force that compelled us toward the objects of our interest. But time and time again, that force was denied. How many times did we hear the word no? How many times were we told we couldn't do what we wanted? How many times were we forced to do things we didn't choose? By conservative estimates, by the time we reach adulthood, we have experienced thousands of denied impulses, moments when our natural desire to learn, explore, or express ourselves was blocked, redirected, or punished. And many of these experiences were never emotionally reconciled. The frustration, the anger, the disappointment, they accumulate. They become a force inside our mental environment, a force that resists anything that denies us the freedom to do what we want, when we want. Now here is the connection to trading. The very reason we are attracted to trading, the unlimited freedom of creativity, is the same reason we feel a natural resistance to creating the kinds of rules and boundaries that could guide our behavior. It is as if we have discovered a utopia of complete freedom, and then someone taps us on the shoulder and says, "Hey, you have to create rules. And not only that, you also have to have the discipline to abide by them." The need for rules makes perfect sense, but it can be extraordinarily difficult to generate the motivation to create them when we have spent most of our lives trying to break free of rules imposed by others. Now let me show you why this matters at a practical level. Because this is not just philosophy. This is the mechanism that destroys trading accounts. In the trading environment, there is no external structure forcing you to behave prudently. The market provides structure in the form of behavior patterns that indicate opportunities. But that is where the structure ends. There are no formalized rules guiding you. There are no beginnings, middles, or endings the way there are in virtually every other activity we participate in. Compare this to gambling in blackjack. The first thing you must do is decide how much you are going to wager. That is a choice forced upon you by the rules. If you don't make it, you don't play. In trading, nobody forces you to decide your risk in advance. Only the consistent winners do that voluntarily. Everyone else avoids it. Because defining risk in advance forces you to confront the reality that every trade has a probable outcome, meaning it could be a loser. In gambling, games have specified endings. If you are on a losing streak, you cannot keep losing without making a conscious decision to put more money at risk. Trading has no formal ending. The market will not take you out of a trade. It will not stop you from losing. You can become what Douglas calls a passive loser, simply ignoring a losing position, while the market takes everything you own. One of the many contradictions of trading is that it offers both a gift and a curse at the same time. The gift is complete control over everything you do. The curse is that there are no external rules or boundaries to structure your behavior. The structure you need has to come from inside your own mind, as a conscious act of free will. And this is where the problems begin, because most people resist creating that structure, even when they intellectually agree that it makes sense. There is another danger that Douglas identifies, and it is subtle enough that most traders never see it operating in their own lives. It is the addiction to random rewards. Research psychologists have studied this phenomenon extensively. In one classic experiment, a monkey is trained to perform a task and is consistently rewarded every time. The monkey quickly learns the association between effort and reward. When the reward stops, the monkey stops performing the task within a very short period. There is no reason to waste energy on something that no longer pays off. But here is where it gets interesting. If the monkey is rewarded on a purely random schedule instead of a consistent one, and then the rewards stop entirely, the monkey cannot know that it will never be rewarded again. Every past reward came as a surprise, so the monkey keeps performing the task, sometimes indefinitely. We are susceptible to the same dynamic, and in trading, it is devastating. Any trade can be a winner, even a big winner. That winner can come your way whether you are a great analyst or a terrible one, whether you follow your rules or break them, whether you take responsibility or avoid it. The random nature of any individual trade's outcome means that even the most reckless, undisciplined approach will produce winning trades from time to time. And each win releases a rush of euphoria, a chemical cascade of pleasure that our brains are wired to seek out again. The addiction to this random reward makes it incredibly difficult to commit to the kind of structured, disciplined approach that is necessary for consistency. Because here is the thing. You don't need any skill at all to put on a winning trade. And if you can put on one winning trade with no skill, you can put on another and another. But that does not mean you are a trader. It just means you got lucky.
Let me tell you about something that happened during one of Douglas's seminars that illustrates the freedom paradox perfectly. He asked a room full of experienced traders, people with 5, 10, even 20 years of market experience. A simple question. How many of you have ever placed a trade that you knew, at the moment you placed it, was a bad idea? Every hand went up. He then asked, and how many of you, at the moment you placed that trade, felt like you had a choice? Almost no hands went up. Think about what that means. Here we're experienced, intelligent adults freely acknowledging that they regularly took actions they knew were wrong. And furthermore, that they felt compelled to take those actions as if some force had seized control of their decision-making apparatus and was operating independently of their rational mind. That force is the accumulated weight of denied impulses, unresolved emotional energy, and deeply ingrained response patterns. When the market activates this energy, when it triggers associations with past experiences of pain or pleasure, The resulting impulse can be so powerful that rational thought is simply overridden. This is why discipline, in the conventional sense of willpower, is insufficient. You cannot outthink a force that operates below the level of conscious thought. You cannot use rational arguments to overcome impulses that originate in your emotional system. The two systems operate on different frequencies, and the emotional system almost always wins. What you can do, and this is the insight that makes the difference, is change the beliefs that generate the impulses in the first place. You cannot overpower the river, but you can redirect its course, and that is precisely what we are learning to do. Douglas often compared the trading environment to a river with no banks. In normal life, social structures act as riverbanks, channeling our behavior in acceptable directions: laws, norms, expectations, consequences. All of these act as constraints that keep us from expressing ourselves in destructive ways. In trading, those banks don't exist. The river flows wherever it wants. And if you don't build your own banks, your own rules, your own constraints, your own discipline, the river of your impulses will carry you into territory that devastates your account. The paradox is that the banks must be self-constructed. Nobody will build them for you. The market won't build them for you. Your broker won't build them for you. They must emerge from your own understanding, your own values, your own commitment to operating in your own best interest. And the materials from which you build those banks are beliefs. That is why the work of installing the 5 fundamental truths is so essential. These truths, when fully believed, act as the riverbanks of your trading behavior. Naturally, automatically, without the need for constant willpower. The final danger Douglas identifies in this chapter is one that affects the most successful people the hardest. It is the problem of external versus internal control. Our entire upbringing has programmed us to function in a social environment. We have learned to depend on other people, and in the process, we have acquired techniques for controlling and manipulating our environment to get what we want. In social settings, these skills work beautifully. The more skilled you are at influencing other people, the more successful you are likely to be. But the market is not a social environment. It does not know you exist. It does not care what you want. It does not respond to your expectations, your desires, your demands, or your efforts to control it. You cannot influence it. You cannot manipulate it. You cannot make it do what you want. This is why so many successful business people, executives, and professionals get destroyed in the markets. Their entire career has been built on their ability to control outcomes. And suddenly, they find themselves in an environment where that ability is completely useless. But here is the insight. You cannot control the market, but you can control yourself. You can control your perception and interpretation of market information. You can control your behavior. Instead of trying to make the external environment conform to your ideas about what should happen, you can learn to govern yourself, to perceive information objectively, and to act in your own best interests regardless of what the market does. Instead of controlling our surroundings so they conform to our idea of the way things should be, we can learn to control ourselves. That is the shift from trying to control the uncontrollable to mastering the one thing you actually can control: your own mind.
Taking responsibility sounds simple. It is one of those phrases we have all heard so many times that we assume we already understand what it means. We have been told to take responsibility since we were children. It has become background noise, a phrase so familiar that it has lost its weight. But in trading, taking responsibility is not background noise. It is the single most important psychological shift you will ever make without it. nothing else works. With it, everything else becomes possible. Let me paint you a picture of what happens when a trader does not take responsibility. Because chances are, you have lived this exact scenario. You put on a trade, the market moves against you, and the first thing your mind does, automatically, instinctively, without conscious effort, is blame the market. The market did this to me. The market took my money. The market betrayed me. This reaction feels completely natural, and it should, because it is wired into us from childhood. Think about all the times in your life when you were doing something you enjoyed, playing, exploring, creating, and someone with more power and authority forced you to stop. Someone took the toy away. Someone made you come inside. Someone told you no for no reason that made sense to your young mind. In those moments, you did not need to take responsibility. You were powerless. The cause of your pain came from outside, and whatever force acted upon you was to blame. We learned very early in life that feeling good can be instantly replaced by feeling bad through no fault of our own. Now, fast forward to adulthood. You are sitting in front of your trading screen. You have a winning trade. You feel fantastic. The market is moving in your direction. And then, suddenly, it reverses. Your profit evaporates. Your account goes negative. The instantaneous shift from joy to pain is identical to what you experienced as a child. And your mind reaches for the same conclusion. Something outside of you caused this. The market did this to you. But here is the truth that every consistent winner has learned. The market doesn't owe you anything. The market is not a social institution that follows rules of fair exchange. In society, if someone wrongs you, there are remedies, courts, contracts, social norms that compel others to treat you reasonably. But the market has no such obligation. Every trader who participates does so for his own benefit. The only way one trader can collect a profit is if some other trader loses. That is the nature of the game. If you have ever found yourself blaming the market or feeling betrayed, then you have not given enough consideration to the implications of what it means to play a zero-sum game. Taking responsibility means acknowledging and accepting at the deepest part of your identity that you, not the market, are completely responsible for your success or failure as a trader. The market's purpose is to separate you from your money, but in the process, it provides you with an endless stream of opportunities to take money from it. Price movement, information, and the ability to enter and exit trades. These represent opportunities. Every moment the markets are open, you have the opportunity to enter a trade, exit a trade, add to a position, or lighten one. Each of these is an opportunity to enrich yourself. Ask yourself this: do you feel responsible for fulfilling some other trader's expectations and dreams? Of course not, the idea is absurd. And yet, when you blame the market for your results, that is essentially what you are doing. You are expecting the collective actions of every other participant to behave in a way that gives you what you want. When you project any degree of responsibility onto the market, two devastating things happen. First, you create an adversarial relationship with the market. The market becomes your enemy. Losing taps into those same childhood feelings of anger, resentment, and powerlessness. And when the market is your enemy, you cannot see the opportunities it is presenting. You are too busy fighting. Second, you mislead yourself into believing that your problems can be solved through more market analysis. This is the trap, because it feels productive. Studying charts, reading books, attending seminars. But if the real problem is your refusal to take responsibility,
then all the market knowledge in the world cannot fix it. You will just use that knowledge to justify not taking responsibility in more sophisticated ways.
Let me tell you what happens when a typical trader's journey begins. He puts on his first few trades. Maybe he wins. In fact, let's say he wins several times in a row. He feels incredible. A carefree state of mind settles over him. He starts to believe that trading is easy, that the money will just keep flowing in. Then he loses for the first time, and the shift from euphoria to pain is abrupt and shocking. Now, in this moment, there are two possible responses. The first, and this is the response of a mature, developed trader's mindset, is to recognize the loss as a natural consequence of trading. No different from the cost of inventory for a restaurant owner. Just part of doing business. Accept, learn, move on. The second response, the one that almost every new trader actually has, is pain, followed by blame, followed by a burning desire for revenge against the market. Our hypothetical trader doesn't quit. He is too driven by the memory of what winning felt like. So he resolves to become smarter. He will learn about the markets. He dives into trend lines, chart patterns, candlesticks, Fibonacci retracements, stochastics, oscillators, Elliott waves, the full buffet of technical analysis. And here is the insidious part. It feels good. Learning about the market is intellectually stimulating. There is always something new to discover, always another indicator to test, always another pattern to recognize. The process of learning creates its own sense of progress and achievement. But something strange happens. The more he learns, the harder it becomes to actually trade. He hesitates. He second-guesses his signals. He sees a clear opportunity and doesn't take it. His performance gets worse, even as his knowledge gets better. How is this possible? Because he is learning for the wrong reason. He is not learning to build a systematic approach to winning. He is learning to prevent the market from hurting him again. He is using knowledge as a shield against pain. And this shift, from offensive to defensive, from seeking opportunity to avoiding pain, changes everything about how he interacts with the market. He has unwittingly created a vicious cycle, where the more he learns, the more debilitated he becomes. The more debilitated he becomes, the more he feels compelled to learn. The cycle continues until he either quits in disgust or, and this is the rare, beautiful outcome, he discovers that the real source of his problems is not the market. It is his own perspective. Now, Douglas identifies a specific category of trader that is perhaps the most interesting and the most heartbreaking. He calls them the boom and busters. These are traders who have learned enough to make money. They can string together winning streaks that would make any analyst envious. Some go months without a losing day. 15 or 20 winning trades in a row is not unusual for them. But the streaks always end the same way, with a catastrophic loss. What happens is this. As the wins accumulate, confidence is good. Up to a point beyond that point, confidence transforms into euphoria, and euphoria is a state where the very concept of risk ceases to exist in your mind. Nothing can go wrong. You are invincible. You are the market. In this state, putting on a position that is much larger than usual doesn't just seem acceptable. It feels compelling. You are so certain of the outcome that risk management seems like an unnecessary inconvenience. And then, one tick against you. And because the position is oversized, that one tick creates an outsized loss. Your certainty evaporates, panic sets in. You freeze, and by the time you unfreeze, the damage is catastrophic. The boom and bust cycle is one of the most painful experiences in trading because it is so close to success. These traders are not clueless. They are skilled. They understand the markets. They can read patterns. They can execute trades. They can make money. But they cannot keep it. And the reason they cannot keep it is not a deficiency in their market knowledge. It is a deficiency in their psychological structure. Douglas asks these traders, and if you are one of them, he is asking you, if you could go back and redo every losing trade that was the result of recklessness or an error, how much money would you have right now? What would your equity curve look like? For most boom and busters, the answer is stunning. They would be in the category of consistent winners. The skill is already there. The mindset is not. And here is the question that matters most. When you experience those losses, do you assume complete responsibility? Or do you look to the market, wondering what you missed, wondering what you need to learn to prevent it from happening again? If you take responsibility, you open yourself to growth. You ask the right questions. You examine your own beliefs, attitudes, and behaviors. You look inward. If you blame the market, you stay exactly where you are. You learn more about charts. You add more indicators. But nothing changes. Because the problem was never about charts or indicators. The problem is you. Taking responsibility is the cornerstone of a winning attitude. If your goal is to trade like a professional and be a consistent winner, then you must start from a premise that might seem counterintuitive at first. The solutions are in your mind, not in the markets. Consistency is a state of mind, not a technique, not a system, not a set of indicators on a chart. It is a state of mind that has at its core certain fundamental thinking strategies that are unique to trading. Think back to your own best trades, the ones where everything clicked, where you saw the setup, entered the trade without hesitation, managed it without anxiety, and exited with profit and clarity. What was that experience like? For most traders, those trades felt easy, effortless. You didn't have to try. You saw what you needed to see, and you acted on what you saw. You were in the moment, part of the flow. There was no struggle, no resistance. Your actions seemed obvious and natural. Now consider this. If trading can be that easy, and you know it can, because you have experienced it, then why isn't it that easy all the time? The answer is that in those moments of effortless trading, you were operating from a mental state that most people cannot maintain. You were free from fear. You were not trying to get anything from the market. You were not hoping or expecting or demanding. You were simply available, ready to perceive whatever the market was offering and to act on what you perceived. The moment you begin trying to win, trying not to lose, trying to be right, you introduce resistance, and resistance takes you out of the flow. It's like trying to be happy. The very act of trying to be happy implies that you are not happy, and the effort itself prevents you from getting there. Douglas makes a distinction that is subtle but critically important. He says that people who are consistently successful at trading don't try to be consistent. They are consistent. It is a natural expression of who they are, of how they think, what they believe, and how they relate to the market. This is not a semantic game. It is the difference between forcing and flowing, between fighting the current and swimming with it, between white-knuckling every trade and trading with the relaxed confidence of someone who knows, truly knows.
that the outcome of any individual trade doesn't matter. Your very best trades were easy and effortless. You didn't have to try to make them easy. They were easy. There was no struggle. So how do you get to that state? Not by trying harder, not by learning more about the markets, not by finding a better indicator or a more precise entry signal. You get there by learning to think in a completely new way about risk and uncertainty. You get there by developing beliefs and attitudes that make fear irrelevant. You get there by eliminating the mental processes that cause you to block, distort, or selectively perceive market information based on what will make you feel good or help you avoid pain.
Let me be very specific about what happens when you don't have this mindset. When you trade from the perspective of trying to get something from the market, your mind is oriented toward expectation. You expect the market to confirm your analysis. You expect it to move in your direction. You expect to be right. And when the market doesn't fulfill that expectation, when it does something different from what you wanted, your mental defense mechanisms activate automatically, without your conscious awareness. Your mind blocks the threatening information. It distorts what you see. It finds ways to maintain a pain-free state of mind, even as the market is screaming at you that you are wrong. You have experienced this. You have been in a losing trade, watching the market make consistently higher highs against your short position. And somehow you focused only on the 1 or 2 ticks that went in your direction. It's coming back. You told yourself. This is just a pullback. Meanwhile, the market kept going against you. Why couldn't you see what was happening? Because your mind was protecting you from the emotional pain of admitting you were wrong. It was filtering the information, showing you only what you wanted to see, blocking everything else. And here is the cruelest irony. The moment you finally exited the trade, the moment there was nothing at stake, you could suddenly see clearly. The opportunity to trade in the opposite direction, which had been obvious to anyone watching without a position, was suddenly visible to you. But it was too late. This is what Douglas means when he says the struggle is internal. It feels like you are fighting the market, but you are fighting yourself. You are fighting your own fear, your own expectations, your own defense mechanisms, your own unwillingness to accept reality. When the internal struggle ends, everything becomes easy. At that point, you can take full advantage of all your skills, analytical or otherwise, to eventually realize your potential as a trader. So how do you accept the risks of trading without emotional discomfort and fear? When at the very moment you perceive the risk, you simultaneously feel the discomfort and the fear. This is the central challenge, and the answer lies in understanding that the fear is not caused by the market. It is caused by what the market means to you. And what the market means to you is determined by your beliefs. Douglas illustrates this with a story about one of his clients, a man who was deathly afraid of snakes. This man had been afraid of snakes for as long as he could remember. One evening, while his wife was out of town, he and his 3-year-old daughter were invited to a friend's house for dinner. The friend's child had a pet snake. When the child brought out the snake, the man practically leapt across the room in terror. But his daughter, his 3-year-old daughter, was completely enthralled. She was fascinated by the snake. She couldn't stop touching it. The man was shocked. He had assumed, without even thinking about it, that his daughter would be afraid. His own fear was so intense, so real, so consuming, that he could not imagine anyone not sharing it. But of course, there was no reason for his daughter to be afraid. She had never been taught to fear snakes. She had never had a painful experience with one.
Without anything in her mental system to define the snake as threatening, her natural response was pure, unadulterated fascination. This is exactly what happens in trading. Most traders assume that the best traders are afraid of the same things they are: being wrong, losing, missing out, leaving money on the table. But that the best traders somehow neutralize these fears through willpower, courage, or nerves of steel. This assumption is wrong. The best traders are not overcoming fear. They don't have fear to overcome. They have developed beliefs and attitudes that prevent them from perceiving market information as threatening in the first place. When you truly accept the risk, there is nothing to be afraid of. And when there is nothing to be afraid of, you don't need courage. You don't need nerves of steel. You don't need self-control.
When you accept the risk the way the pros do, you won't perceive anything that the market can do as threatening. If nothing is threatening, there's nothing to fear. If you're not afraid, you don't need courage. Very few people start trading with these beliefs already in place. Almost everyone has to develop them. And the path of development is almost always the same: a cycle of pain, loss, frustration, and eventually, if they persist long enough, a breakthrough. The breakthrough comes when you stop trying to avoid the pain and start embracing the uncertainty. When you stop fighting the market and start governing yourself. When you stop looking for answers in charts and indicators and start looking for answers in how you think. That is the journey ahead of us, in the chapters to come. We are going to go deep into the architecture of the mind, the beliefs, the perceptions, the associations, the energy structures that shape how you see the market and how you respond to what you see. We are going to dismantle the mental frameworks that generate fear and replace them with frameworks that generate flow, confidence, and consistency. It will not require extraordinary intelligence. It will not require exceptional willpower. It will require only this: a willingness to look inward, to examine what you believe and why, and to consider the possibility that the way you have been thinking about trading is the very thing that has been holding you back. Douglas draws a powerful analogy between trading and athletic performance. And it is worth exploring in depth because it illuminates something crucial about the nature of consistency. Think about the greatest athletes you have ever watched perform. Michael Jordan in the 1998 NBA Finals, Serena Williams at her peak, Roger Federer making shots that seemed to defy physics. What was the common element in their best performances? They were in the zone, a state of mind where action and awareness merge, where the athlete is not thinking about what to do, they are just doing it. There is no second guessing, no hesitation, no internal debate. The body moves with a fluidity and precision that seems almost supernatural. Athletes describe the zone in strikingly similar terms. Time slows down. The ball appears larger. The basket seems wider. Everything feels effortless. The athlete is completely present, completely focused, completely free from fear. Now here's the key insight. The zone is not a state you can force yourself into. You cannot will yourself into the zone any more than you can will yourself to fall asleep. The harder you try, the more it eludes you. It is a state you arrive at when the conditions are right, when fear is absent, when expectations are released, when you are fully present in the moment. What Douglas realized is that the zone is available to traders just as it is available to athletes, and the conditions that produce it are identical. The trader who is in the zone is not worried about losing, not attached to being right, not anxious about the outcome, not trying to prove anything.
They are simply perceiving what the market is offering and responding to it. Naturally, effortlessly, spontaneously. But, and this is the critical distinction, athletes develop the ability to enter the zone through years of deliberate practice. They train their bodies and their minds. They develop the physical skills and the mental attitudes that create the conditions for zone experiences to occur. Most traders skip this training. They want the results without the preparation. They want the effortless performance without the deliberate practice. And when they don't get it, they assume they need more knowledge about the markets, when what they actually need is more work on their own psychology. The trading exercise in Chapter 11 is the equivalent of those 10,000 golf balls. It is deliberate, structured practice designed to develop the mental skills, not market skills, mental skills, that create the conditions for consistent performance. It is not glamorous. It is not exciting. It does not involve discovering some revolutionary new indicator or pattern. It involves 20 trades executed according to rules without deviation, without the thrill of creative interpretation, without the excitement of going off script. And that is why it is so effective. Because it trains the one muscle that matters most. The muscle of disciplined execution. The muscle that separates the 95% who fail from the 5% who succeed.
When Douglas talks about the flow state, or being in the zone, he is describing something very specific. It is not just feeling good about your trading. It is not just confidence. It is a qualitatively different state of consciousness. In the flow state, there is no internal dialogue, no second guessing, no anxiety about the outcome. The mind is quiet and alert, like a still lake reflecting the sky with perfect clarity. Information enters, is processed, and produces action, all without the interference of ego, fear, or expectation. Athletes describe it as time slowing down. Musicians describe it as the instrument playing itself. Writers describe it as the words writing themselves. In each case, the conscious, rational mind steps back and allows the deeper, more skilled parts of the psyche to operate without interference. For traders, the flow state manifests as a seamless integration of perception and action. You see a setup form. You recognize it instantly, not through laborious analysis, but through pattern recognition that happens below the level of conscious thought. Your fingers move to the keyboard. The order is placed. The market moves. You manage the trade. You exit. You move on. There is no drama, no anguish, no thrill, just competent, effortless execution. Now, here is the paradox. The flow state is characterized by the absence of trying. The moment you try to enter the flow state, you have already left it. The moment you try to make a trade work, you are no longer flowing. The moment you try to be right, you are fighting. And fighting is the opposite of flowing. This is why the mechanical stage is so important. By committing to a mechanical system, by removing all discretion, all interpretation, all creativity from the process, you create the conditions in which the flow state can emerge naturally. When you are not trying to be right, you are free to perceive clearly. When you are not trying to predict, you are free to respond spontaneously. When you are not attached to the outcome of any individual trade, you are free to execute flawlessly. The mechanical stage is not a permanent state. It is a training ground, a laboratory, where you can develop the mental muscles that will eventually allow you to trade with full creative freedom. The subjective and intuitive stages, without losing your discipline. But you must earn that freedom. You earn it by proving to yourself that you can follow rules, manage risk, and accept uncertainty, not as a burden, but as the very essence of the game.
You don't have to try to create the flow. Remove the obstacles, and the flow occurs naturally.
One of the primary objectives of everything we are doing here is to teach you how to take the threat of pain out of market information. Let me say that again, because it may be the single most important sentence in this entire book. We are learning how to take the threat of pain out of market information. From the market's perspective, it does not generate happy or painful information. It is all simply information prices. Move up prices, move down patterns, form and dissolve, volume increases and decreases. None of this information carries an emotional charge. It is neutral as the weather, as neutral as gravity. And yet, when you are sitting in front of your trading screen, it doesn't feel neutral at all. A tick against your position feels like an assault. A series of losses feels like a personal attack. A missed opportunity feels like a betrayal. The information feels emotionally charged, positively when it confirms what you want, negatively when it contradicts your expectations. But here is the truth that professionals understand, and that struggling traders do not. It is your own mental framework that determines how you perceive the information, how you feel. And as a result, whether you are in the most conducive state of mind to spontaneously enter the flow and take advantage of whatever the market is offering. Professional traders do not perceive anything about the markets as painful. Therefore, no threat exists for them. If there is no threat, there is nothing to defend against. Their conscious and subconscious defense mechanisms never kick in. And that is why they can see and do things that mystify everyone else. They are in the flow because they are perceiving an endless stream of opportunities. To understand how this works, we need to understand something fundamental about perception itself. Think of everything in the external world as a force that generates information about its properties and characteristics. Everything outside of our bodies generates information that has the potential to act as a force on one of our 5 physical senses. When we encounter anything in the environment, an exchange of energy takes place. Energy from the outside gets transformed by our nervous system into electrical impulses, which are then stored in our inner mental environment as memories, distinctions, and beliefs. These memories and beliefs exist as structured energy that has taken a specific shape and form inside our minds. Now here is where it gets crucial. The information stored inside our minds, our memories, beliefs, and associations, acts as a force on the information coming from outside. It shapes what we perceive. It filters what we see. It colors our interpretation of everything the market does. In other words, what you see in the market is not an objective reflection of what is happening. It is a reflection of what is happening, filtered through the lens of everything you already believe. Douglas illustrates this with a powerful story about a young boy and a dog. Imagine a boy who has never encountered a dog before. He is walking down the street and sees a dog for the first time. Being a child, curious, open, unafraid, he is fascinated. He approaches the dog with pure, uninhibited excitement. But this particular dog is not friendly. As the boy reaches out, the dog growls, lunges, and bites him. The boy is terrified. He runs home in pain and fear. Now, the boy has acquired a new belief. Dogs are dangerous. This belief is stored as a structured pattern of energy in his mental environment. Energy that carries a strong negative emotional charge. Days later, the boy is walking down a different street and encounters a different dog. This dog is friendly, playful, tail wagging, tongue lolling. From the dog's perspective, it is offering nothing but friendliness and potential joy. But what does the boy perceive? He perceives a threat.
His mind automatically and instantaneously links the external information, the sight of a dog, with his internal memory of being bitten. The association is unconscious. It happens faster than rational thought. And the result is that the boy experiences fear, intense, overwhelming fear, even though the dog is offering only playfulness.
The boy's experience is real. His fear is real. But his perception is not an accurate reflection of what the dog is offering. He is perceiving his own internal reality, his own belief about dogs, reflected back at him from the outside world. This is exactly what happens when we trade. Let me give you a direct trading example. Imagine you are sitting at your screen and your trading system generates a clear buy signal. All the criteria are met, the pattern is there. The opportunity is present. But your last 2 or 3 trades were losers. What happens? The market generated a signal, but your mind takes that signal and routes it through your most recent experiences of pain and loss. The association is automatic. The market gave you a signal just like this before, and you lost money. So now, instead of perceiving an opportunity, you perceive a threat. You hesitate. You want to get in, but you are paralyzed by the memory of recent losses. While you hesitate, the market moves in the direction of the signal. Now you are conflicted. You don't want to miss the trade, but you don't want to chase the market either. The tug of war inside your mind intensifies. And in the end, you do nothing. You watch the market move in exactly the direction you predicted. Now change the scenario. Everything is the same. Same market, same signal, same pattern. But your last 3 trades were winners. Would you hesitate? Of course not. If you are like most traders, you might even be considering putting on a position much larger than usual because you feel so confident. In both scenarios, the market generated exactly the same information, the same signal, the same opportunity. But your state of mind was completely different. And your state of mind determined what you perceived, how you interpreted it, and what you did about it. The market did not cause you to hesitate in the first scenario. And the market did not cause you to feel overconfident in the second scenario. Your own mind, specifically, the unconscious association between current market information and your most recent trading experiences, caused both responses. If you can accept the fact that the market doesn't generate positively or negatively charged information as an inherent characteristic of the way it expresses itself, then the only other way information can take on a positive or negative charge is in your mind. Understanding and learning how to circumvent the mind's natural tendency to make these automatic associations is one of the most important skills you can develop as a trader. The mind does this constantly, outside of our conscious awareness. Every piece of market information that enters our senses is instantly linked with something already inside us. And that link determines everything: our perception, our interpretation, our emotions, and our actions. The goal is not to stop the mind from making associations. That is impossible. The goal is to develop a state of mind where the associations, the market triggers, do not contain the threat of pain. When there is no threat of pain, there is no fear.
When there is no fear, you perceive objectively. And when you perceive objectively, you can act in your own best interest. Every time.
If there is such a thing as a secret to the nature of trading, a single principle around which everything else revolves, this is it. At the very core of your ability to trade without fear or overconfidence, at the very core of your ability to perceive what the market is offering from its perspective, instead of from the perspective of your hopes and fears. At the very core of your ability to stay completely focused in the now moment opportunity flow. At the very core of your ability to spontaneously enter the zone. It is this, a strong, virtually unshakable belief in an uncertain outcome, with an edge in your favor. The best traders have evolved to the point where they believe, without a shred of doubt or internal conflict, that anything can happen. They don't just suspect that anything can happen. They don't just say the words. Their belief in uncertainty is so powerful that it actually prevents their minds from associating the current situation with the outcomes of their most recent trades. By preventing this association, they keep their minds free of unrealistic and rigid expectations about how the market will express itself. Instead of generating expectations that result in emotional and financial pain, they have learned to make themselves available, to take advantage of whatever opportunities the market offers in any given moment. Making yourself available is a very specific perspective. It means understanding that the framework from which you are perceiving information is limited relative to what is being offered. There are things you can see, and there are things that are invisible to you. Opportunities that exist in the market right now, at this very moment, that you cannot perceive because you haven't yet developed the mental frameworks to recognize them. The typical trader does not operate from this perspective. The typical trader operates from the assumption that what he cannot see, hear, or feel does not exist. He trades as if the information he perceives is all the information there is. And this assumption is the root cause of virtually every trading error. Think about it. If the trader truly believed in the existence of all the hidden variables that have the potential to act on prices in any given moment, all the traders sitting on the sidelines about to enter the market, all the traders already in the market about to change their minds, all the orders that haven't been placed yet, then he would also have to believe that every trade is an uncertain outcome. And if every trade is truly an uncertain outcome, how could he ever justify not defining his risk in advance, not cutting his losses, not having a systematic way to take profits? Not adhering to these three fundamental principles is the equivalent of committing financial and emotional suicide. And yet, most traders don't adhere to them. They don't define their risk. They don't cut their losses. They don't take profits systematically. Why? Because they believe they already know what is going to happen next, based on what they perceive in the current moment, the pattern, the indicator, the feeling in their gut. They become convinced that this trade will work. And if it is going to work, there is no need for risk management. This belief that you know what is going to happen is the source of virtually every trading error. It creates rigid expectations. And when the market doesn't fulfill those expectations, it creates pain, which triggers fear, which contaminates every future perception. Douglas asks us to consider the hidden variables that are always at work in the market. These are the forces that make every trade an uncertain proposition, regardless of how compelling the analysis may be. At any given moment, do you know how many traders are sitting on the sidelines watching the same market you are watching, about to enter?
You don't. Do you know how many of them want to buy and how many want to sell? You don't. Do you know how many shares or contracts they are willing to trade? You don't. What about the traders who are already in the market, whose participation is already reflected in the current price? At any given moment, how many of them are about to change their minds and exit their positions? If they exit, how long will they stay out? And when they come back, which direction will they trade? These are not theoretical questions. These are the actual forces that determine every price movement in every market every day. And they are unknowable completely, absolutely, permanently unknowable. No amount of technical analysis, no indicator, no pattern, no algorithm can tell you what these hidden variables will produce. You can analyze the footprints left by the collective behavior of traders in the past. You can identify patterns that have repeated with statistical reliability. But you cannot know what will happen next, because the specific combination of traders, positions, and tensions and actions that will create the next price movement has never existed before. This is not a limitation of your skill or knowledge. It is a fundamental characteristic of markets. Markets consist of human beings, and human beings are inherently unpredictable at the individual level, even though they exhibit reliable patterns at the collective level over large sample sizes. The best traders do not try to pretend these hidden variables don't exist. They do not try to rationalize them away through more sophisticated analysis. They take them into account. They factor them into every component of their trading regimes. When you fully accept the existence of these hidden variables, you accept that the outcome of every trade is genuinely uncertain. And that acceptance, true, deep, unconditional acceptance, changes everything about how you trade. It eliminates the need to predict. It eliminates the disappointment of being wrong. It transforms losses from personal failures into statistical costs. And it frees your mind to perceive what is actually happening instead of what you expect to happen. The only reason he would believe it isn't necessary is that he believes he already knows what's going to happen next, believing, assuming, or thinking that he knows will be the cause of virtually every trading error he has the potential to make. The most effective and functional belief a trader can acquire is this: anything can happen. This is not pessimism. This is not resignation. This is the literal truth about how markets work. And when you truly believe it, when it becomes part of the operating system of your mind, it acts as an expansive force on your perception. It opens your mind to see possibilities that were formerly invisible. It prevents you from associating the current moment with past experiences in a way that distorts your perception. Because if anything can happen, including things you haven't imagined, then there is nothing for your mind to avoid, nothing to block, nothing to filter out. You become available to see what is actually there, instead of seeing only what you expect to find. And most importantly, when you believe that anything can happen, you will be training your mind to think in probabilities, which is, by far, the most essential thinking skill a trader can develop, and also the most difficult.
Exactly what does it mean to think in probabilities? And why is it so essential to your consistent success as a trader? To answer this question, all we have to do is look at the gambling industry. Casinos spend vast amounts of money, hundreds of millions, even billions of dollars, on elaborate hotels designed to attract people to their gaming floors. If you have ever been to Las Vegas, you know exactly what I am talking about. Now, here's the question.
How do these corporations justify spending vast sums of money on hotels and casinos, whose primary function is to generate revenue from an event that has a purely random outcome? The answer contains a paradox, and inside that paradox is the key to everything. The paradox of probabilities. Random outcome, consistent results. Casinos make consistent profits day after day, week after week, year after year, by facilitating events that have purely random outcomes at the same time. Most traders, who believe that market outcomes are not random, cannot produce consistent profits. Shouldn't a non-random outcome produce consistent results? And shouldn't a random outcome produce random, inconsistent results? Logic suggests yes, but reality says no, and the gap between logic and reality is where most traders get lost. What casino owners, experienced gamblers, and the best traders understand, and what the typical trader finds difficult to grasp, is that events with probable outcomes can produce consistent results if you can get the odds in your favor, and there is a large enough sample size. The best traders treat trading exactly like a numbers game, similar to how casinos and professional gamblers approach gambling. Let me illustrate with the game of blackjack. The casino has approximately a 4.5% edge over the player, based on the rules the players must follow. This means that over a large enough sample size, a large enough number of hands played, the casino will generate net profits of about 4.5 cents on every dollar wagered. That average includes every player who walks away a big winner. It includes every winning streak. It includes every player who walks away a big loser. And it includes everybody in between. At the end of the year, the casino always ends up with approximately 4.5% of the total amount wagered. If $100 million is wagered, collectively at all of a casino's blackjack tables over the course of a year, the casino will net approximately $4.5 million. Now, here's what makes this possible. And here's what makes thinking in probability so difficult. It requires two layers of belief that, on the surface, seem to contradict each other. The first layer is the micro level. At this level, you must believe in the uncertainty and unpredictability of each individual hand. You know this uncertainty is real because there are always unknown variables. How other players will play their hands, the order of cards in the deck that make the outcome of any particular hand genuinely uncertain. The second layer is the macro level. At this level, you must believe that the outcome over a series of hands is relatively certain and predictable. The certainty at this level comes from the fixed, constant variables, the rules of the game that are designed to give an advantage to one side. So the casino operator holds two beliefs simultaneously. He does not know what will happen on any individual hand, and he does know, with a high degree of confidence, what will happen over a series of hands. He does not need to know or predict the outcome of each hand in order to produce a consistent result over time. This is the mindset that the best traders have adopted, and this is what makes them fundamentally different from everyone else. The best traders treat trading like a numbers game, similar to the way in which casinos and professional gamblers approach gambling.
Now, let me show you 5 fundamental truths about trading that, when truly believed, will align your mental environment with the way the market actually works. These truths are the foundation of thinking in probabilities. Truth number 1. Anything can happen. This might seem obvious, but most traders do not truly believe it. If they did, they would never be surprised, never feel betrayed, and never say, "I can't believe the market did that." Every moment in the market is influenced by every trader who is participating. Any single trader, anywhere in the world, can negate the validity of any pattern or signal. 20 traders can enter the market at any moment and completely change the dynamic of what you are looking at. This
means that no matter how skilled your analysis, no matter how clear the signal, the outcome of any individual trade is genuinely uncertain. Truth number 2. You don't need to know what is going to happen next in order to make money. Read that again. You do not need to know what is going to happen next to make money. This is perhaps the most liberating truth in all of trading. Because if you do not need to know, then you do not need to be right. And if you do not need to be right, then being wrong carries no emotional charge. You are freed from the tyranny of needing to predict the future. Truth number 3. There is a random distribution between wins and losses for any given set of variables that define an edge. This is the core of probabilistic thinking, even with a genuine edge, a pattern that puts the odds in your favor. The distribution between individual wins and losses is random. You cannot know in advance which trades will be winners and which will be losers. You only know that over a sufficient number of trades, the edge will produce a net positive result. Truth number 4. An edge is nothing more than an indication of a higher probability of one thing happening over another. Your edge does not guarantee anything on any individual trade. It simply tilts the odds slightly in your favor, and that slight tilt is all you need, provided you participate in enough trades to let the probabilities work themselves out. Truth number 5. Every moment in the market is unique. This may be the most difficult truth to internalize. Our minds are wired to identify similarities between what we see now and what we have experienced before. And the market will constantly produce situations that look, sound, and feel exactly like previous situations. But they are not the same. The underlying traders, the underlying dynamics, the underlying forces are always different. The similarities are surface level. The reality is unique. When you truly believe in the uniqueness of each moment, your mind stops trying to make the current moment identical to some past experience. The association mechanism that typically distorts your perception is neutralized, and you are free to perceive what is actually happening instead of what your mind expects to happen, based on what happened before. Now, here's what happens when you fully believe these 5 truths and operate from them consistently. You will no longer hesitate before entering a trade because you know that you don't need to know the outcome to make money. You will not be afraid of losing because you have already accepted the loss before you enter the trade. You will define your risk on every trade because you genuinely believe that any single trade can go against you. You will not let a winning trade turn into a loser because you have no rigid attachment to the outcome. You will not overtrade or take excessively large positions because you don't believe any trade is a sure thing. And you will not feel betrayed by the market because you understand that the market is not doing anything to you. It is simply expressing itself, and your job is to perceive what it is expressing and act accordingly. When I put on a trade, all I expect is that something will happen. Regardless of how good I think my edge is, I expect nothing more than for the market to move or to express itself in some way.
The best traders know how much they are willing to risk before they enter. They know where they will exit if the trade doesn't work. They know how they will take profits if it does. And they know these things with absolute clarity, without doubt, and without internal conflict. And when the market tells them their edge isn't working, they accept it, completely without emotional pain, without blame, without the need to rationalize or justify. They exit, accept the loss as the cost of doing business, and wait for the next edge to appear. One of the most practical shifts in thinking that Douglas advocates is the shift from a single trade mentality to a sample size mentality.
And this shift, once made, transforms the emotional landscape of trading more profoundly than almost anything else. When you think in terms of single trades, every trade matters. Every trade is a referendum on your skill, your intelligence, your worth as a trader. A winning trade validates you. A losing trade diminishes you. The emotional stakes on every trade are enormous. Now compare that with sample size thinking. When you think in terms of 20 trades, or 50, or 100, no individual trade matters. The winner doesn't validate you because it was expected as part of the distribution. The loser doesn't diminish you because it too was expected. Think about it this way. If I told you that your trading system has a 60% win rate, what does that mean? It means that out of every 100 trades, approximately 60 will be winners and 40 will be losers. But, and this is crucial, you have no way of knowing the sequence. You could start with 10 losers in a row or 10 winners or an alternating pattern. The distribution within the sample is random, even though the aggregate result is predictable. If you are thinking in terms of single trades, those 10 consecutive losers would be devastating. You would question your system. You would question yourself. You would experience mounting fear, despair, and potentially abandon the system at the worst possible moment, right before the inevitable streak of winners that would bring the long-term statistics back in line. But if you are thinking in terms of sample sizes, 10 losers in a row are annoying but not meaningful. They are just data points within a larger distribution. You know, mathematically, statistically, with complete confidence, that the edge will express itself over a sufficient number of trades. 10 losers do not change that truth. They are simply the random noise that you expected to encounter. This is the casino mindset. The casino does not shut down when a high roller goes on a winning streak. It does not fire the dealers. It does not change the rules. It knows, with mathematical certainty, that the edge will prevail over time. And so it stays in the game. It deals the next hand, and the next, and the next. When you can approach your trading with this same mindset, when each individual trade is just one hand in a very long game, the emotional intensity drops dramatically. You don't care about being right on this trade. You care about being consistent over the next 100 trades. And that shift in time horizon transforms everything about how you behave. You stop overreacting to wins and losses. You stop adjusting your system after every drawdown. You stop chasing the high of a winning streak. You just execute, trade after trade, hand after hand, following the rules, trusting the edge, and letting the probabilities do their work. If you believe in the 5 fundamental truths, and you believe that trading is just a probability game, not much different from pulling the handle of a slot machine, then you'll find that this exercise will be effortless. That is what thinking in probabilities looks like in practice. It is not complicated. It is not intellectually demanding. But it requires a complete restructuring of how you relate to uncertainty, loss, and the need to be right.
Now the task before you is clear. Properly integrate the 5 fundamental truths into your mental environment at a functional level. Not just intellectually, not just as nice ideas you agree with, but as core beliefs that operate automatically, shaping your perception, your interpretation, your decisions, and your actions without conscious effort. This is the difference between knowing something and believing something. You can know that you should cut your losses. You can agree that cutting losses is essential. You can even write it on a sticky note and paste it to your monitor. But if you don't believe it at the deepest level of your being, if the belief hasn't become part of your mental operating system, you will not act on it when it matters most. Let me define the problem as clearly as I can.
At the most fundamental level, the market is a series of up and down ticks that form patterns. Technical analysis defines these patterns as edges, indications of a higher probability that the market will move in one direction over another. But here is the paradox again. A pattern implies consistency, yet each occurrence of the pattern is unique. The patterns may look and measure exactly the same from one occurrence to the next, but the similarities are only surface level. The traders who contributed to the formation of one pattern are always different from the traders who contributed to the next. So the outcome is random relative to each individual occurrence. Our minds have an inherent design characteristic, the association mechanism, that makes this paradox extremely difficult to deal with practically. When we see a pattern that looks like something we have seen before, our minds automatically assume the outcome will be the same. And this assumption is the source of an enormous number of trading errors. So what determines what we perceive, how we define it, and how we interpret it? Our beliefs working in conjunction with the association and pain avoidance mechanisms. Our beliefs act as a force on our senses, causing us to perceive, define, and interpret market information in a way that is consistent with what we expect. And what we expect is simply what we believe, projected into some future moment. Here is how the cycle works. Each moment from the market's perspective is unique. But if the information being generated by the market is similar to something already in your mind, the two sets of information, outside and inside, automatically become linked. This link triggers a state of mind, confidence, fear, euphoria, regret, that corresponds to whatever belief or memory the outside information was linked to. And here is the critical insight. Our state of mind is always the absolute truth. If you feel confident, you are confident. If you feel afraid, you are afraid. You cannot dispute the quality of energy flowing through your mind and body at any given moment. But, and this is where most traders go wrong, the beliefs that triggered your state of mind may or may not be true relative to the possibilities that exist in the market at that moment. Just like the boy and the dog, the boy's fear was absolutely real, but the dog was not dangerous. His perception was a reflection of his internal belief, not an accurate reflection of external reality. When you understand this, truly understand it, you gain the ability to question your own reactions. You can look at your fear and ask, is this fear a response to something real in the market? Or is it a response to an internal association that may have nothing to do with what the market is actually offering right now? This kind of self-awareness is the beginning of freedom. Freedom from the tyranny of your own habitual mental patterns. Freedom to see what is actually there, instead of what your past conditioning tells you is there.
Now let me bring all of this together into a practical framework. The 5 fundamental truths that Douglas presents are not arbitrary philosophies. They are functional tools. Tools designed to create a specific architecture in your mental environment that eliminates fear and enables consistency. When you truly believe that anything can happen, there is nothing for your mind to avoid. When you truly believe that you don't need to know what will happen next to make money, you eliminate the pressure to predict to be right, to validate your intelligence through the market. When you truly believe in a random distribution between wins and losses, you stop trying to pick winners. You start thinking in series, in sample sizes, instead of agonizing over individual trades. When you truly believe an edge is just a probability, not a certainty, you naturally define your risk, cut your losses, and manage your positions appropriately. And when you truly believe every moment is unique, the association mechanism that distorts your perception is neutralized. You stop seeing ghosts of past trades and current opportunities. You see what is actually there. Douglas addresses a paradox that lies at the heart of trading psychology, and it is worth examining in detail because it is the source of so much confusion and frustration. The paradox is this: the more you know about the market, the more you expect to be right. And the more you expect to be right, the more painful it is to be wrong,
And the more painful it is to be wrong, the more your fear mechanisms distort your perception and behavior. In other words, knowledge, which should make you a better trader, can actually make you worse if that knowledge comes with an expectation of certainty. Consider two traders. Trader A has spent 10 years studying technical analysis. He knows every pattern, every indicator, every divergence, every Fibonacci extension. When he looks at a chart, he can identify multiple setups simultaneously. His analytical skill is extraordinary. Trader B has spent 2 years in the market. He knows one simple pattern, a moving average crossover. His analytical skill, compared to Trader A, is rudimentary. Now, which trader is more likely to be consistently profitable? You might assume Trader A, but Douglas would say it depends entirely on their psychological makeup. If Trader A uses his extensive knowledge to project certainty onto the market, if he looks at his sophisticated analysis and concludes that the market must move in a certain direction, then his knowledge becomes a liability. Because when the market doesn't conform to his analysis, his pain is proportional to his certainty. And 10 years of study have made him very, very certain. If Trader B, on the other hand, uses his simple system with full acceptance that any individual trade might not work, if he defines his risk, follows his rules, and doesn't attach his ego to the outcome, then his simplicity becomes an asset. He has fewer beliefs for the market to violate, fewer expectations for the market to disappoint, less ego invested in being right. This is why Douglas says that the more you think you know, the less successful you will be. He is not arguing against knowledge. He is arguing against the attachment to knowledge, the belief that knowledge should confer certainty, and that certainty should confer success. The best traders have extensive knowledge, but they hold it lightly. They use it to identify probabilities, not certainties. They use it as a tool, not as a source of identity. And when their analysis turns out to be wrong, as it inevitably will, on some percentage of trades, they accept the result without emotional disturbance, because their ego was never invested in being right. Operating in a state of not having to know. That is the most difficult and most important thing you will ever learn as a trader. Together, these beliefs create something remarkable. A mental state where you are at peace with not knowing what is going to happen next. And from that place of peace, you can interact with the market from a perspective where you make yourself available to let the market tell you, from its perspective, what is likely to happen next. At that point, you will be in the best state of mind to spontaneously enter the zone, where you are tapped into the now moment opportunity flow.
If you can sense the benefits of adopting the 5 fundamental truths about trading, then the task is clear. Learn how to properly integrate these truths into your mental system as core beliefs that do not conflict with any other beliefs you already hold. At first glance, this might seem like a daunting task, and under other circumstances it would be. But here is why it is achievable. Once you understand the nature of beliefs, how they form, how they operate, and how they can be changed, the process becomes much more manageable. Let me start with a word of caution that Douglas emphasizes strongly. Many traders, when they encounter new insights about trading psychology, make the mistake of assuming that understanding is the same as believing. It is not. Think about the trader Douglas calls Bob, a CTA, a professional money manager, who came to one of his workshops because, despite years of experience, he couldn't produce more than a 12% return. Bob thoroughly understood the concept of probabilities. He could explain it elegantly. He agreed with it completely. But he could not function from a probabilistic perspective. The knowledge was in his head, but not in his operating system.
Understanding a concept is often just the first step integrating it at a functional level. The level where it automatically shapes your perception and behavior without conscious effort is an entirely different process. It requires active training, especially when the new concept conflicts with existing beliefs. And here is the thing about existing beliefs. They resist change powerfully. Douglas identifies 3 primary characteristics of beliefs that you need to understand to effectively transform your trading mindset. First, beliefs seem to take on a life of their own, and they resist any force that would alter their present form. Throughout human history, people have endured torture, persecution, and death rather than express themselves in a way that violated their beliefs. That is the power of belief. It is not a passive mental construct. It is an active force that maintains its structural integrity even under extreme pressure. In your trading life, this means that all beliefs about the need to be right, about what it means to lose money, about whether you deserve success, will not simply step aside because you have learned something new. They will resist. They will argue. They will express themselves in ways that undermine your new intentions. Second, all active beliefs demand expression. A belief does not sit quietly in your mind waiting to be called upon. It actively seeks opportunities to express itself. If you believe that losing money is terrible, that belief will express itself every time you are in a trade. Through anxiety, through hesitation, through premature exits, through the inability to accept a loss gracefully. If you believe that you must be right to be a good trader, that belief will express itself through rigidity, through the refusal to cut losses, through the tendency to add to losing positions, through the emotional devastation you feel when you are wrong. Third, beliefs keep working, regardless of whether or not you are consciously aware of their existence. This is perhaps the most important characteristic, because it means that beliefs you formed decades ago, in childhood, in school, in your first trading experiences, are still operating in your mental environment right now, shaping your perception and behavior in ways you cannot see. A child who is told that he deserved to be hurt because he disobeyed may grow up to be a trader who unconsciously sabotages his own success, because somewhere deep in his mental system, a belief exists that says he doesn't deserve to win. Now, here is the crucial question. If beliefs resist change, demand it, how can we possibly install new beliefs? The answer lies in understanding that beliefs are energy, and energy, while it can be powerful, can also be redirected, transformed, and gradually replaced through a deliberate, disciplined process. Douglas uses the metaphor of truth being relative. What is truth? Whatever works. If a belief helps you achieve your objective, if it produces consistent, satisfying results, then it is useful. It is true relative to what you are trying to accomplish. If a belief produces frustration, loss, and emotional pain, then it is not useful, regardless of how strongly you believe it. The truth is a function of whatever works in relation to what we are trying to accomplish at any given moment.
Understanding how beliefs resist change helps us understand why changing them is possible, but only through a specific process. Think of a belief as a table with legs. The table's surface is the core idea. Losing money is terrible, for example. The legs are the experiences that support the idea. Every time you lost money and felt terrible, a new leg was added to the table. Every time someone told you that losing money is bad, another leg was added. Over time, the table became sturdy, supported by dozens, perhaps hundreds, of reinforcing experiences. Now, here is how beliefs can be changed.
You cannot just knock the table over. It's too heavy, too well supported. But you can weaken it, one leg at a time. Every time you take a loss according to your plan and realize it doesn't feel terrible, it just feels like the cost of doing business. You remove a leg from the old table, and simultaneously, you add a leg to a new table. Losses are a natural part of trading and do not diminish me. Every time you accept being wrong without emotional distress, you remove a leg from the table that says, being wrong is shameful, and add a leg to the table that says, being wrong is information. Every time you resist the urge to chase a trade and discover that the missed opportunity was not, in fact, catastrophic, that another opportunity appeared 10 minutes later, you remove a leg from the table that says, I must never miss an opportunity, and add a leg to the table that says, opportunities are endless. This is why the trading exercise in Chapter 11 works. It is not a test of willpower. It is a systematic process for weakening old beliefs and strengthening new ones through repeated. Each of the 20 trades provides an opportunity to either reinforce the old, destructive beliefs or build new, functional ones. The key is awareness. Awareness of which beliefs are being activated. Awareness of which impulses are arising. Awareness of the difference between what your old beliefs are telling you to do and what your new understanding says you should do. And then, the hardest part, choosing to act in accordance with the new understanding, even when the old beliefs are screaming at you to do something different. It gets easier. Every repetition makes it easier. Because every time you act from the new belief, you add energy to it. And every time you resist the old belief, you withdraw energy from it. The process is gradual, but cumulative, and eventually, sometimes sooner than you expect, there comes a moment when the old belief simply doesn't fire anymore. It has been drained of enough energy that it can no longer influence your perception or behavior. That is the moment of transformation. And it doesn't come with fireworks or dramatic revelations. It comes quietly, almost imperceptibly, as a gentle loosening of tension that you didn't even know you were carrying. The truth is, whatever works. If a belief helps you achieve your objective, if it produces consistent, satisfying results, then it is useful. The practical implication is this: you don't have to prove your existing beliefs wrong. You don't have to fight them head-on. You simply have to develop new beliefs that are more useful, beliefs that produce better results. And over time, through repeated experience and deliberate practice, the new beliefs will gain energy and strength, while the old beliefs gradually weaken. This is not an overnight process, but it is a well-defined process with predictable results. And that process is what the final chapters are designed to teach you.
If the external environment can express itself in an infinite combination of ways, then there is no limit to the number and types of beliefs available to be acquired about the nature of our existence. There is endless variety in what can be learned and believed. And yet, we do not live our lives in a manner consistent with that openness. We argue, we fight. We insist that our way is the right way, sometimes with such intensity that we are willing to destroy everything around us to prove it. Why? What is it about beliefs that makes us so intolerant of divergent viewpoints? Douglas offers a fascinating theory. Beliefs are not just structured energy.
They appear to be conscious energy, energy that has some degree of awareness. How else can we explain our ability to recognize on the outside what corresponds to what is on the inside? How would we know when our expectations are being fulfilled? How would we know when they are being violated? Consider these universal human experiences. Everyone wants to be believed. It feels good when someone agrees with us. It feels bad when someone disagrees. We don't like having our beliefs challenged. The challenge feels like an attack. We naturally gravitate toward people who share our beliefs and feel uncomfortable around people who hold opposing views. These responses are not random preferences. They are expressions of the beliefs themselves. Beliefs that seem to act with their own agency, attracting what is similar and repelling what is contradictory. The implications for trading are profound. If your beliefs actively shape your perception, filtering what you can see and blocking what contradicts your expectations, then your ability to perceive the market objectively depends entirely on the content of your beliefs. If you believe the market is out to get you, you will perceive every adverse price movement as a personal attack, and you will miss the opportunities hidden within those same movements. If you believe you must be right, you will see only the evidence that supports your position, and you will be blind to the evidence that contradicts it. If you believe that losing money is catastrophic, you will feel emotional pain at the first sign of a losing trade, and that pain will trigger behaviors that make the loss worse.
Douglas also addresses something that rarely gets discussed in trading education: the impact of self-evaluation beliefs on trading performance. Every one of us has a sense of self-worth, a set of beliefs, both conscious and unconscious, that argue for or against our right to accumulate success and prosperity. If you have more positive energy arguing for success than negative energy arguing against it, you have a positive sense of self-evaluation. If the balance tips the other way, you have a negative one. And here is what makes this so treacherous. It is almost impossible to grow up in any social environment without acquiring at least some negatively charged beliefs that argue against your success. Maybe you were told as a child that wanting too much money is greedy. Maybe you absorbed the message that you don't deserve good things. Maybe a religious teaching instilled the idea that wealth is inconsistent with spirituality. These beliefs may have been forgotten consciously, but they have not been deactivated. They continue to operate in your subconscious, influencing your behavior in ways that are often invisible to you. Douglas describes a phenomenon he calls the negative zone, the opposite of what athletes call the zone. In the negative zone, money flows out of a trader's account as mysteriously and relentlessly as it flows in when the trader is in the positive zone. He has worked with many traders who built steadily rising equity curves over months, only to experience a sudden, dramatic drawdown, always at the same point in their equity curve. Not because the market changed, not because their system stopped working, but because they hit an invisible ceiling, a level of success that exceeded what their subconscious beliefs said they deserved. If you have ever experienced a pattern like this, consistent gains followed by sudden, inexplicable losses, it may be worth considering the possibility that the cause is not external. It may be internal, a belief you don't even know you have, expressing itself through lapses in concentration, through unexplained errors, through the sudden inability to follow rules you normally follow without effort. I am
am not implying that you have to deactivate every belief that would argue against your ever-expanding positive sense of self-evaluation. Because you don't. But you must be aware of the presence of such beliefs and take specific steps in your trading regimen to compensate when they start expressing themselves.
If you asked me to distill trading down to its simplest form, I would say that it is a pattern recognition numbers game. We use market analysis to identify the patterns, define the risk, and determine when to take profits. The trade either works or it doesn't in any case. We go on to the next trade. It is that simple. But it is certainly not easy. In fact, trading is probably the hardest thing you will ever attempt to be successful at, not because it requires intellect. Quite the contrary. But because the more you think you know, the less successful you will be. Trading is hard because you have to operate in a state of not having to know. Even though your analysis may turn out at times to be perfectly correct, to operate in a state of not having to know, you have to properly manage your expectations. And to properly manage your expectations, you must realign your mental environment so that you believe, without a shadow of a doubt, in the 5 fundamental truths. Let me state them one more time, because they cannot be repeated enough. 1. Anything can happen. 2. You don't need to know what is going to happen next in order to make money. 3. There is a random distribution between wins and losses for any given set of variables that define an edge. 4. An edge is nothing more than an indication of a higher probability of one thing happening over another. 5. Every moment in the market is unique. Douglas describes 3 stages of development that a trader must pass through on the journey to mastery. Understanding these stages gives you a map, a clear picture of where you are and where you need to go. The first stage is the mechanical stage. This is where most traders need to begin, and it is where the most fundamental transformation takes place. In this stage, you learn 4 things. First, you build the self-trust necessary to operate in an unlimited environment. You prove to yourself, through action, not just understanding, that you can follow rules, manage risk, and behave in your own best interest, even when your emotions are telling you to do something different. Second, you learn to flawlessly execute a trading system, not perfectly. Flawlessly meaning you do what the system tells you to do, without deviation, without hesitation, without creative embellishment. Third, you train your mind to think probabilities. You internalize the 5 fundamental truths so deeply that they govern your perception and behavior automatically. Fourth, and this is the culmination of the first 3, you create a strong, unshakable belief in your consistency as a trader. You don't just hope to be consistent. You know you are consistent. It becomes part of your identity. Once you have completed the mechanical stage, you can advance to the second stage, the subjective stage. In this stage, you use everything you have ever learned about market movement to do whatever you want to do. There is a great deal of freedom in this stage. But with freedom comes responsibility. Specifically, the responsibility to monitor your susceptibility to the kind of trading errors that result from unresolved self-evaluation issues. The third stage is the intuitive stage. This is the most advanced level of trading development, the equivalent of earning a black belt in martial arts. At this level, trading becomes intuitive. You don't analyze your way to decisions. You sense them.
You feel what the market is about to do before it does it. But here is the important thing about intuition. You cannot try to be intuitive. Intuition is spontaneous. It does not come from what you know at a rational level. It comes from a deeper place. A place that the rational mind does not fully understand. In fact, often mistrusts. Douglas has worked with many traders who frequently had powerful intuitive senses about what the market was going to do, only to override those senses with rational analysis. The rational part of their mind argued for a different course of action. And the result, almost invariably, was that the intuitive sense was right and the rational analysis was wrong. The only way to develop and trust your intuition is to create the mental conditions that allow intuitive impulses to be received and acted upon without interference from the rational mind. And that begins with the mechanical stage.
Let me now walk you through the trading exercise that Douglas designed for the mechanical stage. Because this exercise is the practical tool that integrates everything we have discussed into a functioning part of your trading identity. The exercise is deceptively simple. But do not mistake simplicity for triviality. Every aspect of it is designed with precision. Step 1. Choose a market to trade and define your edge. Your edge is a set of variables, a specific pattern or combination of indicators that, based on the market's historical behavior, indicates a higher probability of the market moving in one direction over another. The variables must be absolutely objective. There can be no subjective interpretation involved. Either the pattern is present or it is not. Either the signal is there or it is not. There is no gray area. Step 2. Define your risk. Before you enter any trade, you must know exactly how much you are willing to lose. There must be a price point, determined before entry, at which you will exit if the trade moves against you. This point represents the threshold beyond which the edge is no longer valid. Beyond that point, staying in the trade is not trading. It is hoping. Step 3. Define how you will take profits. You must have a systematic method for taking profits. This could be a specific target, a trailing stop, or any other rule-based approach. But it must be defined in advance. Step 4. Commit to trading a full sample size. This is crucial. You must commit to taking at least 20 consecutive trades that fit your edge. 20 occurrences in a row. Without deviation, without skipping trades, without using outside information, and without changing your rules. 20 trades, not 1, not 3, not whichever ones feel right. 20 consecutive occurrences of your edge, executed exactly as your system defines them. Why 20? Because 20 trades is a large enough sample to begin revealing the statistical characteristics of your edge. It is large enough to demonstrate whether your system produces a net positive result when executed consistently. And, most importantly, it is large enough to force you to confront every psychological obstacle that stands between you and consistent execution. Here is the key insight. By setting up the exercise with rigid variables, fixed odds, and a commitment to take every trade, you have created a trading regime that duplicates how a casino operates. Why do casinos make consistent money on events that have random outcomes? Because they know that over a series of events, the odds are in their favor. And they also know that to realize the benefits of those favorable odds, they have to participate in every event. They cannot pick and choose which hands of blackjack, which spins of the roulette wheel, or which rolls of the dice they will participate in. If you truly believe in the 5 fundamental truths, if you truly believe that trading is a probability game not much different from pulling the handle of a slot machine, then this exercise will be effortless.
Your desire to follow through will be in complete harmony with your belief in the probabilistic nature of trading. There will be no fear, no resistance, no distracting thoughts, nothing to stop you from doing exactly what you need to do, when you need to do it, without reservation or hesitation. On the other hand, if you are like most traders, this exercise will create a head-on collision between your desire to think objectively in probabilities and all the forces inside you that are in conflict with this desire. The degree of difficulty you experience will be in direct proportion to the degree of these internal conflicts. Do not be surprised if your first few attempts are extraordinarily difficult. Do not be surprised if you find yourself breaking the rules, skipping trades, adding subjective interpretation, or abandoning the exercise entirely. This is not failure. This is information. Each time you deviate, each time you struggle, you are getting a direct readout of the beliefs inside you that are in conflict with probabilistic thinking, and each conflict that surfaces is an opportunity for transformation.
I want to spend a moment on Douglas's concept of self-discipline, because it is quite different from what most people think discipline means. Most people associate discipline with willpower, the ability to force yourself to do something you don't want to do. In this view, discipline is about overcoming resistance through sheer determination, gritting your teeth, pushing through, white-knuckling it. Douglas sees discipline differently. For him, self-discipline is not about force, it is about refocusing. When you notice that your attention has drifted, that you are thinking about the last trade, or worrying about the next one, or fantasizing about how much money you might make, or dreading how much you might lose, you gently redirect your attention back to the present moment, back to your system, back to the 5 fundamental truths. This is much closer to meditation than it is to military discipline. It is the practice of noticing when your mind has wandered and bringing it back, without judgment, without frustration, without harshness, just noticing and redirecting again and again and again, over time. And this is the magic of the process. The redirection becomes easier. The wandering becomes less frequent. The truths become more firmly embedded. Not because you force them in through willpower, but because you practice them into existence through gentle, persistent. This is how beliefs change. Not through confrontation, but through practice. Not through argument, but through experience. Every time you successfully redirect your attention and execute a trade according to your system, you are adding a tiny bit of energy to the new belief. I am a consistently successful trader. I'm withdrawing a tiny bit of energy from the old belief, whatever it may be, that was holding you back. It is like water wearing away stone. Each individual drop is insignificant, but over time, the accumulated effect is transformative. The stone changes shape, the belief changes form, and one day, you may not even notice when it happens. You realize that the old fears and conflicts simply aren't there anymore. They have been replaced by something lighter, more flexible, more true. You don't become a consistent winner through a single dramatic breakthrough. You become one through thousands of small, quiet, disciplined repetitions. Douglas offers specific guidance for how to handle these conflicts when they arise. First, monitor yourself. Pay attention to your thoughts, your feelings, and your impulses. When you notice that you are thinking, saying, or doing something that is inconsistent with the 5 fundamental truths, acknowledge it. Don't deny it. Don't suppress it. Simply notice it and recognize it for what it is. A part of your psyche that is arguing for its version of the truth. Second, use the technique of self-discipline. Self-discipline is not about forcing yourself to do things through willpower. In Douglas's framework, self-discipline means deliberately refocusing your attention on your objective when you notice yourself drifting away from it. It is a gentle but persistent redirection. Write down the 5 fundamental truths and the 7 principles of consistency. Keep them visible at all times when you are trading. Read them aloud with conviction. Every time you notice a conflict, return to these truths. Let them anchor you. The 7 principles of consistency are: 1. I objectively identify my edges. 2. I predefine the risk of every trade. 3. I completely accept risk, or I am willing to let go of the trade. 4. I act on my edges without reservation or hesitation. 5. I pay myself as the market makes money available. 6. I continually monitor my susceptibility for making errors. 7. I understand the absolute necessity of these principles of consistent success, and therefore, I never violate them. Let me unpack each of these principles, because understanding them intellectually is the first step toward making them part of your operating system. Principle 1. I objectively identify my edges. Objectivity means seeing what is there, not what you hope is there, not what you fear is there, and not what your ego needs to be there. Objectively identifying an edge means looking at the market and determining, based on your predefined criteria, whether a trading opportunity exists right now. If it does, you act. If it doesn't, you wait. There is no forcing, no wishing, no creative interpretation. Most traders struggle with this because they want to trade. They want to be in the market. Sitting on the sidelines feels like missing out. And so they start seeing edges that aren't there. Phantom patterns created by their desire to act rather than by the actual behavior of the market. The discipline of objective identification means accepting that sometimes, often, the market does not present your edge. And during those times, doing nothing is the most profitable action you can take. Principle 2. I predefine the risk of every trade. This seems so obvious that it hardly needs explanation. And yet, it is violated more often than any other principle. Why? Because predefining risk means confronting the possibility of loss before the trade begins. And most traders do not want to face that possibility. They want to believe the trade will work. They want to feel confident, optimistic, certain. Defining the risk feels like an admission of doubt. But here is the reality. Doubt is the appropriate mental state for someone operating in an uncertain environment. Not crippling doubt, not paralyzing doubt, but healthy, functional doubt. The kind that says, I believe this trade will work, and I accept that it might not. Both statements can be true simultaneously. And when they are, you are in the optimal mental state for trading. Principle 3. I completely accept risk, or I'm willing to let go of the trade. This is the deepest and most transformative principle. Accepting risk means that you have genuinely made peace with the possibility of losing money on this trade. Not tolerating it, not bracing for it, making peace with it. To the point where, if the loss occurs, you experience it as a natural, expected cost of doing business. No different from a restaurant owner buying food that might not sell. If you cannot reach this state of acceptance, if the loss will cause you emotional pain, then you should not take the trade. Better to miss an opportunity than to take a trade that will activate your fear mechanisms and compromise your judgment. Principle 4. I act on my edges. without reservation or hesitation. When your system generates a signal, you act immediately without waiting for confirmation, without seeking reassurance, without looking for one more reason to feel good about the trade. Hesitation is a symptom of fear, and fear, as we have established, distorts perception. The moment you hesitate, you have left the realm of objective assessment and entered the realm of emotional decision-making. And emotional decisions in trading are almost always wrong. Principle 5. I pay myself as the market makes money available. Taking profits is a skill that most traders underestimate. It seems like the easy part, the enjoyable part. But many traders find it extraordinarily difficult to take profits, for the same reason they find it difficult to take losses. They are attached to the outcome. When a trade is profitable, the mind wants more. It holds on, hoping for a bigger gain. And then the market reverses, and the profit evaporates. The trade that was a winner becomes a loser. Not because the market did something unpredictable, but because the trader was unwilling to accept the profit that was offered. Paying yourself means having a systematic plan for extracting profit from winning trades and executing that plan without negotiation. Principle 6. I continually monitor my susceptibility for making errors. This is the principle of self-awareness. It means paying attention to your own mental and emotional state while you are trading. Are you feeling euphoric? That is a warning sign. Euphoria leads to overconfidence and recklessness. Are you feeling angry? That is a warning sign. Anger leads to revenge trading. Are you feeling desperate? That is a warning sign. Desperation leads to poor risk management. The ability to monitor yourself while trading is a skill that develops over time. It requires a part of your mind to stand apart from the action and observe, calmly, objectively, without getting swept up in the emotions of the moment. Principle 7. I understand the absolute necessity of these principles of consistent success, and therefore, I never violate them. This is the principle that ties all the others together. It is a commitment, a promise to yourself, that you will not negotiate with these principles. You will not make exceptions. You will not tell yourself, just this once. Because just this once is how every deviation begins. And deviation is the enemy of consistency. These 7 principles are the operating code of a consistently successful trader. Not one of them references a specific market, a specific indicator, or a specific trading strategy. They are universal. They apply to every market, every time frame, every style of trading. This is why Douglas says that the skill of trading is psychological. The market knowledge, the patterns, the indicators, the analysis is just the surface layer. Below that surface, governing everything, are these principles. And below the principles are the beliefs that determine whether you can follow them. These principles are not suggestions. They are not guidelines. They are the operational code of a consistently successful trader. Every single one of them is essential. Violating any one of them is enough to break the cycle of consistency and invite the forces of fear, euphoria, and self-sabotage back into your trading. Now, here is the beautiful thing about this exercise. Every time you actually follow through, every time you take a trade according to your system without deviation, every time you accept a loss without emotional damage, every time you resist the urge to override your system with subjective opinion, You are drawing energy out of the conflicting beliefs and adding energy to the new belief in probabilities and in your own consistency. It is a cumulative process. Each successful execution strengthens the new belief. Each time you resist old patterns, the old belief weakens slightly over time. Through repetition, through experience, through the lived proof that probabilistic thinking works, the new beliefs become dominant. Eventually, your new beliefs will become so powerful that it will take no conscious effort on your part to think and act in a way that is consistent with your objectives. You will know, with absolute certainty, that thinking in probabilities is a functioning part of your identity. Not because someone told you it should be, but because you have lived it, trade after trade, for a sustained period of time. You will know for sure that thinking in probabilities is a functioning part of your identity when you will be able to go through one sample size of at least 20 or more trades without any difficulty, resistance, or conflicting thoughts distracting you from doing exactly what your mechanical system calls for. Then, and only then, you will be ready to move into the more advanced subjective and intuitive stages of trading, stages where you can use the full depth of your market knowledge, your pattern recognition skills, and your growing intuitive sense to trade with a degree of freedom and flow that most traders never experience. Before we close, I want to leave you with a composite portrait of transformation, drawn from the many traders Douglas worked with over his career. Imagine a trader. He has been in the markets for 5 years. He has tried every indicator, every system, every service. He has attended seminars, read books, subscribed to newsletters. He has had winning streaks that made him feel like a genius, and losing streaks that made him question his sanity. He is smart. He is determined. He understands the markets better than most. And yet, his equity curve is flat, or worse, slowly declining. The wins and losses cancel each other out, with commissions and emotional toll tipping the balance toward red. Then, somehow, he encounters these ideas. Maybe through reading this book, maybe through working with a coach, maybe through hitting rock bottom and being forced to question everything he thought he knew. At first, he resists. Of course, he resists. The idea that his problem is psychological feels like an insult to his intelligence. He has spent years developing his analytical skills. He knows how to read a chart. How could the problem be in his head? But something about the ideas resonates. Maybe it is the description of the 4 primary fears: being wrong, losing money, missing out, leaving money on the table. He recognizes himself in every one. Maybe it is the example of the boy and the dog, the realization that he has been seeing threats that don't exist and missing opportunities that were right in front of him. He begins the trading exercise. 20 trades his edge. Defined objectively his risk. Defined in advance. His profit-taking. Systematic, no deviation. The first few trades are excruciating. He wants to override the system. He sees what he thinks is a better setup. He wants to skip trades that don't feel right. He wants to add trades that look too good to pass up. Every fiber of his being resists the mechanical simplicity of the exercise. But he persists. He writes down the 5 truths. He reads them before every trading session. He monitors his thoughts and gently redirects them when they wander. By trade number 10, something shifts. The resistance starts to fade. The process starts to feel less like a constraint and more like a framework. A structure that paradoxically gives him more freedom. The freedom from second guessing, from indecision, from the paralyzing weight of needing to be right. By trade number 15, he notices something he hasn't felt in years:
calm, the market moves against a trade, and he exits at his predefined point. No drama, no anguish, no blame, just acceptance. And then, the next trade. By trade number 20, something remarkable has happened. His equity curve is rising. Not because his edge got better, not because the market became easier, but because he stopped destroying his own results. He stopped making errors born of fear and euphoria. He stopped fighting the market and started flowing with it. He looks at his trading journal and realizes that the system he already had, the one he had been using for years, was always capable of producing consistent results. He just had never given it the chance to work. His own psychology had been sabotaging it at every turn. This is the transformation that Douglas points to throughout the book. It is not about becoming a different trader. It is about becoming a different thinker. And when your thinking changes, everything else follows. The market does not change. Your charts do not change. Your indicators do not change. What changes is you. The person sitting in front of the screen. The person perceiving the information. The person making the decisions. The person pulling the trigger. When that person changes, when that person learns to think in probabilities, to accept risk, to embrace uncertainty, to trade without fear and without recklessness, then trading becomes exactly what it always promised to be. Easy, simple, and profoundly, deeply satisfying. Not because you are always right, but because you have learned to be right about the things that matter, and to be perfectly at peace with everything else.
We have come a long way together. We started with a question that has haunted traders since the first exchange opened its doors. Why do 95% of traders fail, even when many of them are brilliant, educated, successful in every other area of their lives? And we found the answer. Not in the markets, not in the charts, not in the indicators, not in the trading systems. We found it in the mind. The market is not your enemy. It is not your friend. It is a mirror. It reflects back to you whatever is inside. Your beliefs, your fears, your expectations, your conflicts, your unresolved pain. If you look into that mirror and see a threat, the threat is not in the market. It is in you. And the solution, the only solution that produces lasting, consistent results, is to change what you are bringing to the mirror. The journey from where most traders are to where they need to be is not a journey of acquiring more knowledge about markets. It is a journey of acquiring knowledge about themselves. It is a journey of examining beliefs that were formed in childhood and have been operating invisibly for decades. It is a journey of confronting fears that feel so real, so justified, so rational, and recognizing that they are artifacts of past programming, not accurate reflections of present reality. Mark Douglas spent over 17 years of his life working with traders, studying the psychology of trading, and developing the framework we have explored together. He started as a trader who lost nearly everything he owned within 9 months of moving to Chicago. He experienced the kind of financial and emotional devastation that causes most people to quit forever. But he didn't quit. He looked inward. He asked the hard questions, and he discovered something that changed his life and has changed the lives of thousands of traders since. The discovery was this: the market doesn't need to change. You do. Let me leave you with the 5 truths one final time, not as intellectual concepts, but as a creed, a trader's oath,
words to live by every time you sit down at your screen. Anything can happen. I don't need to know what is going to happen next in order to make money. There is a random distribution between wins and losses for any given set of variables that define an edge. An edge is nothing more than an indication of a higher probability of one thing happening over another. Every moment in the market is unique. And the 7 principles that make these truths actionable. I objectively identify my edges. I predefine the risk of every trade. I completely accept risk, or I am willing to let go of the trade. I act on my edges without reservation or hesitation. I pay myself as the market makes money available. I continually monitor my susceptibility for making errors. I understand the absolute necessity of these principles of consistent success, and therefore, I never violate them. A final note. Try not to prejudge how long it will take before you can get through at least one sample size of trades following your plan, without deviation, distracting thoughts, or hesitation to act. It will take as long as it takes. If you wanted to be a professional golfer, it wouldn't be unusual to dedicate yourself to hitting 10,000 or more golf balls, until the precise combination of movements in your swing was so ingrained in your muscle memory that you no longer had to think about it consciously. When you're out there hitting those golf balls, you aren't playing an actual game. You aren't winning the big tournament. You do it because you believe that skill acquisition and practice will help you win. Learning to be a consistent winner as a trader is no different. The market will be there tomorrow, and the day after that, and the day after that. There is no rush. There is no deadline. There is only the work of aligning your mind with the realities of the market, of building, one trade at a time. A mental structure that allows you to perceive clearly, act decisively, and accept whatever the market offers with equanimity and grace. You don't need luck. You need the right beliefs. And now, you know what they are. The question is, will you do the work?
There is a story that traders tell about Jesse Livermore, one of the most famous speculators in Wall Street history. Livermore made and lost several fortunes over the course of his career. He was brilliant. He could read a tape like nobody else, but he could never master himself. In his memoirs, written under a pseudonym by Edwin Lefebvre, Livermore said something that captures the essence of everything we have explored. After spending many years in Wall Street, and after making and losing millions of dollars, I want to tell you this. It was never my thinking that made the big money for me. It was my sitting. Sitting waiting, being patient, not reacting, not chasing, not forcing. That is arguably the hardest thing in all of trading, harder than learning technical analysis, harder than developing a system, harder than managing risk. Because sitting requires a state of mind that most traders never achieve, a state of peace with uncertainty, of comfort with inaction, of confidence that the next opportunity will come without needing to chase the current one. That state of mind is what Douglas calls the trader's mindset. And everything in this book, every chapter, every concept, every truth, every principle, is designed to help you build it. Let me close with something that Douglas says at the very end of his book. Words that I think are the closest he comes to expressing the spiritual dimension of trading. He says, "Do not prejudge how long it will take. It will take as long as it takes. Like a golfer hitting 10,000 balls, you do the work, not because it is exciting, but because you believe in the process.
You believe that skill acquisition and practice will help you achieve what you seek. Learning to be a consistent winner as a trader is no different. You have the tools now, the 5 truths, the 7 principles, the understanding of how your mind works, how beliefs shape perception, how fears the very outcomes you are trying to avoid. You have the exercise, 20 trades executed according to rules, without deviation. It is all here. The path is clear. I wish you great prosperity. And I would say good luck, but you really won't need luck if you work at acquiring the appropriate skills. The market is waiting, and so is the trader you are becoming. This has been Trading in the Zone.